So hello everyone, is my audio video screen share working fine? Is the audio video screen share everything working? Screen share might not because I've not started it yet. All good. Great to see you, Daniel. Good, long time. So yeah, we'll wait for a few more minutes, maybe a minute or two, and then we can begin. Because I think we are expecting a few more attendees. We have already 30. Yeah. Okay, so I think, yeah, we can begin our discussion. So firstly, good evening and welcome all of you to this short webinar. In fact, before we even start, let me just get the final purpose right. The purpose is purely educational, right? The reason I'm doing this is because in the class, as in some of you, I can see few names, we've interacted in the class. What I've seen is derivatives as a topic, most of the students find it a bit difficult, especially the ones who've given level 2. Even in level 1, derivatives gets a bit difficult. You would have given other exams, be it FRM or CME. You would have come across terms in derivatives, futures, options, call options, put option, premiums, right, margins and strike price and exercise price and basically Black-Scholes model and all these things. But then when it comes to application, it gets a bit difficult, as in it's basically a very different world out there, as in the way you learn in the curriculum versus the way it is done in the real world is very, very different. And that is basically the purpose. So we just had a discussion between us and we just felt that something like this would be very helpful for all our students, and also even in case you have not studied with Kaplan, but then in general, anyone who's interested in derivatives, having a first-hand view of how the markets work. Yeah, we are doing it. So now here, one thing that I've promised myself is I'm not going to use any slides. Everything would be on this platform, as in the, 1 second, sorry. Is the screen share? No, I think there's some problem with screen share. Just a second, guys. Yeah, hey, Sanders, yeah. Can I join? Yeah, please. We just started. Why am I unable to share my screen? So are you all able to see my screen, by the way, everyone? Are you all able to see my screen? I don't know, something strange is happening here. I think, yeah, for you guys, it's okay, but yeah. Yes, Shubhani? Okay, perfect. So see, it's kind of 7:05. We're just starting now, as in you could just assume that we are just starting. Anyone who has joined in just now, I can see if you have just joined right now. So I'll just get the background clear here. The purpose is purely understanding FNO or futures and options from a practical perspective. How does it really work, right? Now, do I trade in futures and options? Yes, I do. But then, honestly, if you ask me, why do I do it? One, to some extent, to hedge, to some extent, pure speculation, right? Now, derivatives, the way we learn about risk management and all is done at an institutional level or purely someone who's a trader. Now, I personally am a long-term investor. So I like to buy stocks and hold it for a long period of time and just forget about it. And then maybe just sell options to increase the yield a bit. But yeah, other than that, pure speculative trading, I generally do purely kind of it's I would say it's just you sometimes feel like speculation, right? That is the only time, but it's a very small amount of funds that I use for it. But what I've realized is doing it on your own is a very, very good way of learning. Right? With derivatives, I always tell there are three ways of learning. One is a classroom, one is the book, right? You read the book and then try to understand what is the future, what is an option, and you will see all these complex definitions. That doesn't help. Second is the way we do it in a class, right? There's a person who's explaining you how things work. That's also, I would say, not a very bad approach, but not the best. The best is doing it on your own. Take aside some money. Anyways, you spend so much money on learning, right? You all spend like 5,000, 10,000 dirhams on courses and learning. Keep that funds aside, maybe 1/10 of that funds aside for doing trading. And the purpose is not making money, right? When you're doing it with such small amount, it is about learning, right? And in that process, you learn a lot of things. Clear? So for here, this, I'm going to show you live how derivative markets work and how one enters into a derivative trade and all. Now, I have an account in the Indian markets, and that is why I'm going to show you some examples from the Indian markets. Now, Indian derivative markets is quite developed, by the way. In fact, if you look at index options, it is more than CME, Chicago Mercantile, or Chicago Boards of Options Exchange. So NSE, that is National Stock Exchange of India, has actually surpassed even the CBOE in some kinds of derivative contracts. So it's definitely a very, very liquid market. Okay. Now, the other thing or the other constraint that we had when we thought of doing this webinar is the time, right? We had to do it during after market hours, after your office hours. Otherwise, none of you would have joined. So we definitely had to do it after office hours. Now, after office hours is also a time when Indian markets are kind of generally shut down, right? So in India, you would see these stock options, stock derivatives, stock futures, all these things, they shut down around 3:30, that is 2 o'clock UAE time. After that, if there is some market open till midnight, is commodity futures. Even currency futures is basically not going to operate right now. But I'm going to show you how all these things work. Okay. So whenever you are trying to do something related to derivatives, you would have, let's say in your academics, would have come across futures, forwards, options, swaps. Clear? Now for you, forwards is out of question. You are never going to enter, you at a personal level, you all are never going to enter into a forward contract. Clear? So this is not a retail product. You will see institutions entering into forward contracts, not NDFs, or in general forward contracts and swap contracts. You with your own personal money, you are never going to do this. Second, swaps, you're never going to do this. Again, I'm not saying that if you work at JP Morgan and you are in a swap dealing team, you might. But with your own personal money sitting in front of a laptop, you're not going to be doing it. So these two things, we are not going to be discussing. So there's no point. The only thing that I could discuss is the conceptual parts, which is anyway something that you learn in an exam. So our focus is futures and options. Clear? We'll learn what is or what exactly is a futures contract, what exactly is an options contract, how do we enter. Again, I don't want to spend a lot of time on explaining theoretical concept, straight on to the point. Clear? Now, futures is an exchange traded product. So when you want to enter into a futures contract, you have to enter into an exchange. Now, what are some well-known exchanges, right? So you have NYSE is a stock exchange, but NYSE also has a derivatives segment. Then there is CBOE, Chicago Board of Options Exchange. For commodities, there is LME, London Metal Exchange, right? There is Chicago Mercantile Exchange, right? Now, where I'm going to be showing you is on MCX, which is Multi Commodity Exchange. Clear? And the other that we have is NSE, CDS, that is currency derivative segment, and NSE equity derivatives segment. These are few markets I'll try to show you. Again, in case you are not from Indian markets, doesn't matter. The purpose is not speaking about a specific market, right? The interface might be slightly different. The time of the trade might be slightly different, but the way the market operates are very, very similar. Clear? So our focus is on futures and options, and within futures and options, it is MCX, NSE currency derivatives, and NSE equity derivatives section. Clear? Now let us focus on this commodity, right? Or how could you trade in commodities? Now, first thing, whenever you have to trade, go to the website of the exchange. Whichever exchange you all are trading, you'll have to go to the exchange of the website. You'll need to know how the product works. Okay. So let's say this exchange is MCX, right? MCX India. Now you're trading in London Metal Exchange, go to that website. Clear? So let's say if it is MCX, which is a commodity derivatives exchange. So it's an exchange which allows you to enter into commodity derivative contracts. Clear? Always look at the products. What are the different type of products it allows you to trade on, right? So there is bullion. Bullion is generally your gold and silver. It's basically metals, precious metals. So there is gold and silver, and in different sizes. Now gold, you can have different contract sizes. Okay. There is base metals that you can trade: aluminium, copper, lead, nickel, zinc. There's energy commodities that you can trade in: crude oil and natural gas. Agricultural commodities like cotton, crude oil, mentha oil, rubber. And there are definitely way more commodities that a more developed exchange might allow you to trade in. Clear? Now, whenever you want to trade in something, you'll also need to understand, firstly, why are you trading? Let's say for me, it is pure speculation. Clear? Okay, so Sanders is here. What do you think? Crude oil prices will go up or go down? Speculate. That's it. And nobody knows anyways. Go up. Okay. So Sanders is here. He says crude oil will go up, right? So the view is crude oil will go up. Now, what can you do? Can I go to this Enoch petrol pump or ADNOC petrol pump and hold crude oil at my home in bottles? Now, that is also one of the ways, but how much can I do? Clear? So how do I play this view? How do I take an exposure to this view that I feel crude oil will go up, right? And that is how financial markets have been created. Every time you have a view, there is a betting instrument to kind of gamble and make, it's a zero-sum game in most cases, okay? But let's say my view is crude oil will go up, right? Now, a trade could be buy crude futures. Now, you know what is futures contract, right? It's a contract where you fix the price at which you will enter into a trade in future, right? So let's say 1 barrel right now is $110. Clear? So which means you enter into a contract to buy crude oil, right? And fix the price now itself. This is basically what you want to do. And if you do that, you can make a profit, right? Because you fix the price. Tomorrow when the prices go up, you make a profit. But how is this executed, right? To do this, you have to enter into a platform, a broker who's going to give you a platform so that you get connected to the exchange. And one such exchange that I'm going to get connected to is multi-commodity exchange. Clear? This is basically my broker. right? As in ignore all these things. This is basically my own personal account, right? You could see, anyone who knows my name, you would know, right? Now, there are different type of commodities that you can trade in. Okay, so what I'll do is I'll just remove all these things from the watch list first, right? So I want to trade in futures and I want to trade crude oil futures. Clear? Now you see MCX, these are the commodity, the name of the exchange. And you see 17th June, 19th July, 19th August, 19th. What is this, by the way? Any idea? What is the 17th June, 19th July? Anyone? Sorry? Length, or these are basically the, yes, very good, Shubhani. These are the expiry dates or the settlement dates. These are basically your expiry dates. Now, why not 18th June? Right? I say 18th June is my birthday. I want it on that day. No, it's not possible. If it was a forward contract, it is possible, right? In a futures contract, these are standardized. Clear? Because see, in a contract, what do you have? In a contract, you have who is long, who is short. Clear? You have the underlying. Okay? You have the underlying. Now, then you have basically a settlement date. Clear? And you basically have a price. Now, this underlying is crude oil in our case. Clear? And there's also quantity. This quantity is specified in the contract note. I cannot go for any quantity. I cannot say I want to enter into 2 barrels, 5 barrels. No. If you look at MCX website, right, this is why I've told you, let's say crude oil products, crude oil. Now in crude oil, they allow you to trade in crude oil futures and options. So if I just check futures, you should ideally look at these contract notes. Okay. You will get it everywhere, as in every website is going to give you. Clear? So if you see contract notes, the trading unit is 100 barrel. So which means if I enter into one contract, it has to be 100 barrel. So it's always in multiples of 100 barrels. Clear? So here, I don't have an option. Quantity has to be in multiples of 100 barrels. Now there are other products also. By the way, if I don't want to enter into such a big trade, if you see here, my platform also allows me another style of contract, right? Crude oil mini. Right, one second. I think now there's, yeah. So there are crude oil mini contracts also. Right now, it's not available, but yeah. So there are contracts where you can trade into 10 barrels also. Okay. But anyways, right now the quantity is 100 barrels. Settlement date is standardized, right? As in the exchange will specify, I don't have a say, right? So there will be set of settlement dates. I can choose which one I want to. So here, if you see again in the contract note, they will tell you the settlement date calendar. Clear? So which means contract expiry date, you want for 17th June, it's available. 19th June, July, 19th August, 19th September, 19th October, 18th November, 19th December, right? Who decides this? Exchange, who's allowing you to trade in these contracts. Clear? So these are fixed. Now I'll decide, right, when I put here crude oil, right? I have 17th June, 19th July, 19th August, 19th September, 19th. I can choose anyone. Generally, these near-term futures contracts are more liquid, right? You would have also studied near-term contracts are more liquid. So let's say I go with this, I add it to my watch list. Clear? Now, this is just commodity futures, right? I can similarly enter into currency futures, right? If I want to enter into USD INR, 27th May, 3rd June, 10th June, 17th June, all these are expiry dates, settlement dates. Let's say I want 27th May, out of question, it's expired. 3rd of June, right? Or maybe 28th of June. I want to lock the price. I can do that. Clear? Now, let's say 28th June. I'm just showing it to you. This way I can put different instruments into my watch list. On the other hand, let's say even a company, I can enter into a futures contract where the underlying is a company. Let's say Tata Motors, right? So it's a company which makes cars, right? So Tata Motors, I can enter into a futures contract that expires on 30th of June. So I can lock the price at which I'll buy shares of this company on 30th of June. That's it. So this way you can, and in here I've just put all these things in my watch list. Okay. And now these two, the first two things that you are seeing is closed. The markets are closed, right? The market for equity future contracts closes at 2 o'clock UAE time. USD INR futures, it closes at 3:30 UAE time. This closes at 10:30 UAE time in the night. Clear? That is why we actually took, and then that is why, and then this is where I will be able to show you more. Now, because it is commodities and because I'm not currently based in India, even I have a lot of restrictions, but still I'll try to show you the practical picture here. Okay. Now, people are trading right now live in crude oil future contracts. Clear? And you don't know who these people are. It's a platform where people are trading. So right now, if you see, if I just click the symbol info, I'll be able to see that here. Clear? So if you see that here, what you would see is there are people who are bidding and there are people who are asking. Clear? Now, what is this bid and ask? We know bid means the price at which someone is ready to buy. Ask is the price at which someone is ready to sell. Clear? Now, what I'll do is I'll take a screenshot of this, or maybe I'll just, and then just remember, because why I told you that I'll take a screenshot of this is because this, otherwise this keeps on changing. Clear? But anyways, as I look at this, I'll need somebody to help me with this because it's a new laptop. Print screen. Oh yeah, got it. Print screen. Okay. And if I just press Alt Windows S. Sorry, Alt Windows. Yeah. No. Okay, one second. I can do it. Just a second, sorry. I'll just show you what that basically means at any given point in time. Okay. And see, in between, if you all have any questions, feel free to ask anything which is not clear. Okay. Just a second. So now here, now this is continuously trading because there is a lot of transactions that is happening. This is basically the spot price. Now you will say, why 885 and all? Because this is basically in INR. We are not talking about US dollars. We are talking about INRs. Okay. Now in US dollars, you would have seen values like $100 and all. Here you are seeing it in INR. That is why you see some very, very big number, because USD INR exchange rate is around 80, as in $1 is around 80 rupees. Okay. Yeah. Just a second, guys. Now, what I'll do is I'll get this screenshot here so that you all know what I'm talking about. So let's say at this point in time, what does this mean? I've taken a screenshot. What does the screenshot mean? This means there is a person somewhere in some part of the world, I don't know, who's ready to buy one contract, which means 100 barrel of crude oil at 8845 rupees per crude oil. Clear? So if you check my order book, let us call this person let's say Sandres. Okay, I don't know, but let's say I'll just call this person Sandres. So what will happen is Sandres wants to buy one contract, which means 100 barrel of crude oil at what price? 8845 per barrel. Clear? And settlement is, when is settlement? Right? What contract were we looking at? We were looking at June 17th. Clear? So I'll say June 17, 2022. Clear? So this is basically the buyer side of this. Clear? Similarly, if you see there's a seller. Seller is going to definitely ask for a higher price. The seller is also ready to enter into a contract, right? Let's call seller Shubhani. Clear? So Shubhani wants to sell one contract, which is 100 barrel of crude oil at 8846 per barrel. Again, settlement is June 17th, 2022. Clear? Again, although here you see two, which means Shubhani definitely wants to sell two, but let's say for the simplicity, one contract. Clear? Now, what will happen? Will the trade go through? No. Why? It is like saying Sanders wants to buy this at 8845. Shubhani wants to sell it at 8846. Trade is not going to go through. Someone has to come down or come up. So either Sanders has to agree for 8846 or Shubhani has to agree for 8845. Is it clear? Now, let us say Sanders has agreed. Right? Sanders doesn't have time to wait. He is very bullish on crude oil. He feels crude oil is going to go up. Sanders can update his order. Clear? So if Sanders updates his order and Sanders says 8846 per barrel, order has matched, what will happen? Trade takes place. Getting it? So which means there's a contract that will happen, let's say somewhere in the back end, you won't be able to see, but Sanders has agreed to buy 100 barrel of crude oil. Shubhani has agreed to sell 100 barrels of crude oil at 8846 per barrel on 17th of July 2020. Is it clear? How do you enter into such contracts? Very simple, right? Now I can just show it to you here with future, like let's say USD INR. If you want to buy or sell, you just come here, buy or sell. You just specify the number of contracts, right? And then you just hit buy. That's it, right? Again, you can put market order, you can put limit order, you can put stop loss, market order, stop loss, limit order. Anyways, it is fine, but just hit buy. That's it. Clear? So this is basically how one can enter into a contract. Now here I'm just showing it to you, the currency part of it, because again, I'm being an NRI and a non-resident in India. There are a lot of restrictions when it comes to trading in commodities, because commodities, generally speculative activities in commodities affects a lot of farmers and all those things. So there are a lot of more restrictions over there. But anyways, this is basically how it works. Now, okay. Now tell me, here we speak about a contract that Sanders and Shubhani has entered into. Clear? Now what happens on June 17th? What do you think? Right? Imagine instead of this 8846, it is 8850. On June 17th, the price of crude oil is 8850. Who is at profit? Who is at loss? Who would be at profit? Who would be at loss? Because Sanders has entered into a contract to buy it at 8846. Clear? So ideally, very good Shubhani, right? Very good Wakar. Seller is at a loss. Shubhani is at a profit. Clear? So which means, think of it this way. The contract was like this, right? The contract was like this, right? Sanders will buy. Shubhani will sell. Clear? 100 barrel crude oil at 8846 per barrel. Clear? On June 17th. Clear? Now on June 17th, if it is 8850 per barrel, think from Sandra's perspective. Sandras will go to Shubhani and tell Shubhani, Shubhani, give me 100 barrel of crude oil. Here is 8846 per barrel. Clear? You get, think of it this way, you get 100 barrel. You paid just 8846. But Sandras, if he sells it in the market right now, what is the price? 8850. So what are you going to get? In a way, you are going to get $4 per barrel. And it is 100 barrels. So 400 rupee profit. That is basically how it works. But now the idea is, does it work this way? Theoretically, this is how it works. Right? Oh yeah, prices go up, you make a profit. Prices go down, you make a loss. That's not how it practically works. Do you really think Shubhani will be able to actually deliver crude oil, or Sandras will actually be able to take delivery of 100 barrels of crude oil? No, Sandras is just a speculator. He's not an ADNOC or a company which really needs crude oil, right? Or wants to sell crude oil, right? He's just a speculator. So the way it works here is, people don't deliver the underlying. That is not how future contracts work. People don't deliver. People wind up the contract. So once you enter into the contract, what you could do is, any time before the expiry, you can wind up your contract. Now, how does that work? So see here, I just said that Sandras wants to buy one contract, that is 100 barrel of crude oil at 8846. So this was basically the trade that happened. Sandras will buy, Shubhani will sell 100 barrel crude oil, and so on. Is it clear? Now, Sandras after 10 days says, I want to exit this contract. Now, Sandras doesn't know where is Shubhani, right? Sandras cannot find Shubhani and exit this contract. They both have entered into this contract. So how do they exit? This is where you'll need to understand exchange plays a very important role, right? Because when Sandras said Sandras will buy, Shubhani said Shubhani will sell, the way it works is, a trade gets divided into two different trades, right? So the counterparty of every trade is, so basically this trade that you see here gets divided into two different trades in the real world, right? Sandras will buy, and here it is not going to be Shubhani, it is going to be clearinghouse of the exchange. On the other hand, when Shubhani has entered into this contract as a seller, it is not really Sandras who's going to buy, it is clearinghouse. Clear? So whenever you enter into a trade through an exchange, the central counterparty is always the clearinghouse. Clear? So now, basically from Sandras' perspective, this is basically what has happened, right? Sandras will buy, clearinghouse will sell 100 barrels of crude oil at 8846 per barrel on 17th June. Is it clear? Now imagine this trade happened when I took that screenshot, right? Which was like 10 minutes back. Right now, Sandras says, I want to exit this contract. How can Sandras exit this contract? Right? So this is basically how a live environment works. Sandras will again come here, right? Now, let me just take a print or again a screenshot of this to explain you. 1 second. Now here, right now at this point in time, this is basically what you see. And see, I have not manipulated anything. Everything is live in front of you. And this is interesting, by the way, okay? Now have a look at this. Right now, this is basically what you see. This is how the bid-ask spreads. This is basically what you see. Now, if Sandras wants to exit, you know what he will do? Yes, very good, Shubhani. He will enter into another contract. So you are entering into a second contract. Clear? So Sandras will this time enter into a contract as a seller. Now, when Sandras enters into this contract as a seller, there is a buyer at 8873. Clear? some part of India or some part of the world, there's a person who's ready to buy at 8873. All you need to do is enter into a contract to sell at 8873. Clear? So what Sandres will do is, right, this time, right, initially Sandres entered that Sandres will buy. This time what will happen is Sandres will enter into a contract as a seller. Now this person, I don't know. Let us say this is not Shubhani. This time it is Daniel, right? So, but Sandres doesn't know it is Daniel, okay? Daniel will buy 100 barrel crude oil. But right now, what is the price? Right now, the ongoing price in the market is 8873. Clear? So it is going to be 8873 per barrel again on 17th June. Clear? Now, even this trade, what will the clearinghouse do is, clearinghouse will say, Sandres, your trade was not with Daniel. Sandres, your trade was with clearinghouse. So it is not Daniel for your perspective. It is clearinghouse. Okay. Now, this is basically how it works. Think of it this way. On 27th May 2022, somewhere at 7:25 p.m., Sandres said, Sandres will buy. Clearinghouse said, I'll sell 100 barrel crude oil at 8846 on 17th June. And maybe 10 minutes later at 7:35 p.m., what did Sandres say? Sandres will sell. Clearinghouse will buy 100 barrel crude oil, 8873. Now tell me, what is going to happen on 17th of June? From Sandres' perspective, first Sandres will buy crude oil at 8846. Then Sandres will sell at 8873 to the same person, clearinghouse. So what is the point of doing all these things? So the way it works is, right now, the moment Sandres enters into this contract, and because these contracts are exactly the same, for same 100 barrel, for 17th June, entered into the same exchange, your trades will get wound up. And Sandres is going to make a profit of 8873 minus 8846 per barrel multiplied by 100. Right now, you could have made a profit of 2007, right? In between these discussions, right? You entered into, because the prices have changed, right? As in, remember when I took this screenshot, people were ready to enter at 8845 and 8846. Second screenshot, people were ready to buy and sell at 8873, 8875. Prices have changed. And when prices change, that is basically what a person, speculator, generally does. They enter into a futures contract as a buyer, and then they again enter into the same futures contract as a seller. The clearinghouse generally winds up the contract. Is it clear? Getting it? So in a live market environment, you really never take, especially as a retail investor, you are never going to take delivery of contract, as in delivery of the underlying asset. Do you think I'm going to take delivery of crude oil or mentha oil or natural gas and all? No, it is just trading on differences. I buy and then I enter into a contract to sell. I really hope that the contract to sell happens at a higher price than contract to buy. Clear? Yeah. Any questions on how does this work? Any questions or anything which is not clear? I can just explain. You all can directly ask anything which is not clear, even if it is not exactly on what we discussed, but yeah, you can directly chat or even unmute yourself. No, sorry, unmute might not be available, but yeah, let me know in case there's anything which is not clear. Do we need any margin? Very, very good question. Now, the person who went long has a question, right? Sanders has a question. Do we need margin? Definitely, yes. Who specifies the margin? The exchange. When I enter into this contract, again, the contract note would give me some idea about what the margin would be. So if you see here, what's going to be the margin? So if you see, there is an initial margin, which is again exchange to exchange, it is difficult. Minimum 10% or based on span. Span basically is standard portfolio analysis. So it's basically a software. It's a system, right? They will decide what the margin would be. Now imagine if the margin is 10%. Okay, for crude oil, imagine if the margin is 10%. So in that case, see, remember when you entered, let's say from Sandra's perspective, you said that you will buy 100 barrel at 8846. So what is the notional value? Notional value is 100 into 8846, which will give you 884,600. 10% of this is something that you have to deposit as margin. Imagine if the margin is 10%. Clear? So this is basically how the margin part of it is. Yes, Wakar, I think both your and Sandra's question was very similar. Yes, you have to deposit a margin. Otherwise, as in the moment you enter into the contract, your broker is going to block a margin. So you need some part of the notional value as margin. Is it clear? Getting it? So this is basically how you enter into a futures contract. Clear? Now, there are also other contracts that you can enter into, which is options. Remember, I told you we are going to be talking about two, futures and options, right? In this example, I just gave you, or in this example, I just explained to you futures and commodity futures. Now, instead of this commodity, it could have been a stock, it could have been a currency, anything. Clear? Now, another product that you can enter into is options. Now, what exactly is an option? Right? You would know there is a premium, there is a call option, there's a put option and all. So even if you see that here, just like futures, remember when I was adding the watch list, when I was creating the watch list, I was saying crude oil and I was saying futures. Similarly, I can also have options. Here, in options, I can decide I want to buy call option or put option. Now, what is the CEPE? It is call European, put European. Anyone who remembers what is European options? Very good. Can be exercised only on the last day or the expiry date, right? So let's say I want to buy call options. Clear? Again, see, the purpose is so that you are able to relate all these things. Okay. Now, tell me, what should Sandres be doing? Should you be buying call option or put option in case you believe the prices will go up? Buy call, which means you are locking the price at which you will buy. Clear? So let's say crude oil, and what price do you want to lock it at? Again, all these strike prices, these are strike prices. You cannot decide it. You and I cannot decide it. Exchange will decide it. Okay. So if you see here, our contracts are available at a difference of 50-50. So there is 8800, 8850, 88, and this way there will be 8,900 this way on 50-50 difference. Okay. So I'll just look at call option. I'll take a particular expiry. Let's say 15th of June, right? 8,800, 8,850. Clear? Let's say 8,800. I'll add this to my watch list. So this is basically an option which I can buy, which will allow me to buy crude oil at 8,800. Clear? So which means there is a piece of paper like this. So the way you have to think is there's a piece of paper like this. And what is written on this piece of paper? It is written option to buy crude oil at 8800 per barrel on 15th, which was that? 15th June 2022. These all are standardized. I cannot change this. Clear? But if you remember, whenever you buy an option, you have to pay something. What was that? Who decides the premium? Exactly. So now there is a premium for this. You cannot just get an option to buy it at 8,800 on 15th of June. Clear? Where is that? It is here. What is the premium? 450 rupees. Getting it? Although you have to pay 450 into 100 because this is everything is on a per barrel level, right? So when you multiply it by 100, it is going to be 450 into 450 into 100. So even here, if you see with respect to options, you will see there's a buyer, there's a seller, right? Even here, there's a buyer who's ready to buy this call option at 447. Seller says 449. Clear? Again, who decides this 447, 449? It's the market. There is a Black-Scholes model which tries to tell you ideally what should it be. Ideally, this should be 448 or 450, right? So there's a model which is a Nobel Prize winning model, although that doesn't work in real world. But this is basically how options work, right? So now, if I just take a screenshot of this to explain you how does this work, let's say I take a screenshot. Now, in case Sandres wants to buy an option, this is basically his thing. And then you can also sell an option. You can be a writer or you can be a holder, right? So here what you see is, if you are ready to pay 450, then you can get an option here to buy crude oil at what is the strike price? Strike price is 8,800. Clear? And even this keeps on changing. Remember, the price keeps on changing. Right here, right now it is 440, and this every second keeps on changing. But this is basically how options work. So in an option, what happens is there is people are basically bidding and asking on premiums, right? Now imagine if Sanders has decided I want to buy the option. So if Sanders has to buy it at this price, 450. Clear? So what will happen here is Sanders is the there's a new laptop, so all the buttons are over the place. Yeah, which is spelling is Sandris. So sorry, right? So let's say Sanders is the holder. Somebody else, anonymous, is basically the writer. I don't know. Shubhani, it could be Shubhani, or it could be Daniel, it could be me, anyone, someone. Clear? Now, what is the underlying? Underlying is crude oil. What is the quantity? It is 100 barrel. You cannot trade in any other multiples. Clear? And what is the strike price? 8,800. When is the expiry? Expiry is 15th June. Clear? And what is the premium? Premium is 450 per barrel. Clear? So if Sanders wants to enter into this option contract, Sanders has to pay 450 rupees multiplied by 100. Clear? To this anonymous person. And Sanders gets an option to buy crude oil at 8,800 on 15th of June. Now, what do you really want? You want the underlying to go up. Clear? Imagine on 15th June 2022, clear? Crude oil is worth, let's say, 10,000. Would Sanders be happy? Yes. Why? You have an option to buy it at 8,800. Clear? So what is your profit? On a per barrel basis, but you have already paid 450. Clear? So your profit before premium would be, which in the CFA curriculum you would have called it as payoff. So the payoff is going to be this minus 8,800, and your profit on a per barrel basis is going to be this minus the premium that you have paid. So you're going to make a profit of 750. You won't realize how big this profit is, right? But only when I tell you that you've kind of made 200% profit or more, 150%, that is when you will realize why. You know, how much was your investment? You don't have to block any money. There is no margin and all involved. You just paid 450 and you've received, right, a profit of 750, right? As in, it's like saying you purchased an option contract at 450. Now the value of the option contract is 1200. So on an investment of 450, you have made a profit of 750. That's like literally more than doubling your money. Clear? So your 450 has become 1200. Now that is the kind of leverage that options might provide. Clear? But just like futures, options are also exchange traded. When we say exchange traded, which means there's a clearing house, which means you are not actually going to buy crude oil and all, right? You don't have an option to exercise, right? The job here is you have to exit. So at what price did you buy, Sandres? 450. So you got an option. Let's say option is this piece of paper. On this piece of paper, it was written option to buy crude oil at 450 at 8,800. Clear? 10 minutes later, if you want to sell this option, this piece of paper that you purchased, if you want to sell it off in the market right now, the price is. So it's very lucky, huh, with sand, as in all these examples are turning profitable. Yeah, it is 454. Clear? So you purchase it for 450. Right now, sell it at 454, 4 unit or 4 rupee profit per barrel, right? And this is basically how options as an instrument works. Again, in real world, it is not about taking delivery and all. The purpose, in fact, that you all really need to understand here is derivatives as a market can be used for hedging, but a large majority of people are using it for speculation. The way it is done is you just enter into contract and wind up the contract when you get favorable prices. Although you get favorable prices when the underlying goes up, right? As in, why are option prices going up? It is because spot prices are going up. Forward price, all these are going up, by the way. As in this 5 minutes of discussion, why has the premiums gone up? Because in general, the spot prices are going up. The future prices also, right, could have gone up, right? This that you see here, all these basically could be going up, or maybe volatility is increasing. But right now, if you see, it's around 8885. Clear? Now, right now it is 8885. When I was showing you an example, it was like 8836 or something, right? So whenever your underlying goes up, value of call option goes up. Underlying falls, call option falls. For put option, it is the exact opposite. But yeah, these are basically how one trades in derivative instruments. Again, the purpose, like I told you here, this entire program, the purpose is not so that you get into all these things from a gambling perspective, but from a learning, as in it's just to apply those theoretical concepts into real world examples. And we are doing this through just understanding the bigger picture, right? Now, swaps and all, like I told you, you're never going to see this in real world. You are just going to learn about it in your CFA or FRM or CME curriculum. But yeah, futures and options with very small amount of money is also something that you can trade in. Clear? Now, any questions on anything that we have discussed, even if it is outside the context, I'll explain using practical examples. Any questions, please? Regarding futures, options, how does it work, clearinghouse, other contracts, contract notes, all these things I can explain it to you practically right away. Yeah. Is it clear? Sandeep has a question. Oh, by the way, great to have you, Sandeep, here in the program. Again, it was long back when we interacted in the class. Otherwise, it's mainly on LinkedIn. But yeah, how does volatility affect? Volatility affects both call option and put option positive, right? As in the premiums, if nothing had changed, And if only the premium has gone up, I would have said because the volatility has gone up. And you can see that easily in a Black-Scholes model calculator. You will get that, okay? Black-Scholes model calculator. Right. In fact, I could do it right now. Right. See, just to give you an example, let's say the spot price was 8,800. Imagine, right? Or 8,500 or whatever. I don't know what the spot price is. Strike price, let's say, is 8,800. Expiry, I can decide, right? Expiry, let's say, is June 15th. Okay. Risk-free rate is, let's say, 5%. And if I calculate, this is a calculator which tells me ideally what should be the call option premium. Clear? Now, if you see here, nothing changes, only the volatility changes to 30. From 18%, the volatility changes to 30%. What you would see is both call option premium, just check both of these. When I hit calculate, value of both of these will change. So volatility affects both call options and put options positively. And there are a lot of traders on volatility. So if you ever feel, as in one way of doing that is there's an index, the Vix Index. So if you look at the CBOE Vix Index, it is 26.16 right now, right? Sometimes it goes up. Whenever your Vix is very, very high, which means there's a lot of volatility in the market, a very good thing to do that time is selling options. Sell call options, sell put options. Why? Because premiums that you would receive is very high. And when the volatility cools off, the premiums also go down. Clear? And at times this volatility can go up a lot, by the way. Okay. Now let me just show this to you. Okay, can anyone identify this spike? What was the spike for? Volatility from 15 to 66. Exactly. This was that lockdown period, right? All of a sudden, the volatility went up. Now at this point, again, it's very easy looking at in the hindsight and saying, oh yeah, I would have sold it here. But yeah, whenever your volatility shoots up, there are a lot of people who use options as a way of betting on volatility. So long vol, short vol traders. Basically, there are a lot of people who could be long on volatility, a lot of people who could be short on volatility. Right? No. So margin, is volatility good for derivatives? Now it depends on whether you have purchased an option. If you have purchased an option, volatility is good. If you have sold an option, volatility is bad. But in general, volatility is not good. As in, people would definitely want very, very low volatility. Now, what does this 20? Yeah, for long, yes. For long options, yes. Now, what does this 26.14 indicate? How should I even interpret this 26.14? Right? You would know that, again, mathematically speaking, you know that returns are normally distributed and all. This 26.14 basically means that with around 70% probability, how that 70 comes, that one-time standard deviation, remember, 68.26% of the data lie between plus and minus, one-time standard deviation. What this basically means is, in a very simple way, I am approximately 70% confident that returns of S&P 500 will be around plus or minus 26%. Clear? An year. A year. Right? On the other hand, if this was here, so at the peak of this, what that basically means is on 20th March, people were thinking that, oh yeah, S&P 500 will be plus or minus 60% in a year, right? So which means the volatility is very, very high, right? But at times the volatility could be very, very low, right? So when volatility is very, very low means, oh yeah, people feel that everything is very smooth. And that time, if you want to go long on volatility, you can again buy options, or you can directly trade Vix Index also by. Okay. Yeah. Now, Wakar, a person deal only through one broker. Can he deal with more than one broker? Although it will be difficult. Yeah, a person can deal with 100 brokers also. So it's not necessary that you have to deal with one broker, right? Especially, and then I personally have around 5 brokers that I use for different purposes, right? Again, it all depends on, it gives you some bargaining power also, right, at times. But there is absolutely no limit to the number of brokers you need to have. But yeah, for institutional investors, it is very good if you have many brokers. Many brokers mean more research team access. That is what you get. More research team access. You also can negotiate on brokerage. But yeah, you can have multiple brokers. But at a personal level, one or two brokers should be enough. Yeah.
If you buy a put
and
buy a stock, can it be combined?
Yeah, very good.
Yeah.
So Sandres has a question. Can we buy a stock and buy a put? Yes. This strategy, by the way, is called as a protective put, which means you buy underlying and you also enter into a contract to sell the underlying at a fixed price, right? You don't have to necessarily sell it, but you can enter into a contract. This is generally done to protect any downside. Just in case prices fall a lot, you have a put option to protect yourself. So you can do that. A lot of people do it. So in any case, if the underlying asset falls a lot, your put premiums will take care of your losses there. As in, you make a huge loss in your underlying, but the put option premium will go up, which will offset some of the losses.
And if the price goes up?
If the price goes up, the good thing is the underlying goes up.
Yeah.
And with put option, you only lose out on the premium. Because if the prices go up, you might not exercise the put option. So then you lose out on the premium, but you can do that. This strategy is called as protective put. Okay, and if you see, the volatility also keeps on changing. By the way, and then it was 26 a few minutes back. Now it is 25.98, right? Within a second, it might again change. Okay, yeah. So options are also one very important instrument when it comes to taking exposure to volatility in the markets. Okay, yeah. So any questions? And even after these programs, y'all are always free to reach out in case you'll have any questions. But yeah, during this program also, in case there's anything not clear, I can definitely help you. And the best way is always create an account, like as in anyone who has, let's say, Indian passport holders, I'll ask you to definitely open an account with any of these Indian brokers. You want to trade in global derivatives market, you have interactive brokers, you have Sarva. The best, I would say, is interactive brokers. In case you want to trade in US markets, there is also eToro. But with all these things, you have to be very, very careful, especially when you're buying stocks. You need to ensure that you are buying stocks, not CFDs. A lot of these, they end up selling you CFDs. So you just need to be a bit aware about what your eToro and Robinhood is doing. But yeah, interactive brokers would be the most genuine broker that you can use for trading in US markets.
For options and futures?
Even options and futures, yes. Yeah, Sandeep, are these options also in lots of 100? Yes, these options are also in lots of 100, Sandeep. But the premium that you see is basically for 1 barrel. So which means if you want to buy that contract, you have to pay 450 into 100. And that also you would see here, right? Go to the contract notes. So if you look at, oh, sorry, not futures. If you want to look at option contracts, right? All these are on 100 barrels. But if you look at products, right? Like for example, gold. So you have gold mini, right? So they allow small people also to trade so that the notional value can come down. So generally gold, right? If you look at gold future contracts, the contract size would be 1 kg. Trading unit is 1 kg. Clear? But 1 kg of gold, right? It basically means a big amount. So if you really don't want to trade in such a big amount, there is gold mini contract. Gold mini contract, if you see, is basically for, let's say, retail traders. This is basically for 100 grams. So it is 1/10 of the size of the initial contract that I showed you. So yeah, you will look at, you can see these commodity contracts in different sizes. But there is a standardization. That is why we say that futures is standardized, options are, or forwards are customized and all.
Can we roll over the option?
Can we
roll over?
See, the rollover is not really, your broker will not allow you to roll over. Rolling over basically means you sell it and you buy it again. But that is generally done in futures. That is, you basically you enter into a contract to buy it on 17th of July, 17th June. Somewhere around 16th June, you will wind up your contract and you will enter into July contracts. Somewhere in July, you wind up the contract, you enter into September.
Anyway, it's like selling and
buying. Yes.
You lose some.
You might lose, you might gain, but yeah, it is about back. It depends on whether you are in a backwardation or a contango. This is again actually covered in level 2, but that's how it works. But yeah, you are allowed to roll over, but rolling over is not really a one single trade. It's basically 2 trades that you have to manually do it. Right, Mahesh, do we have to keep minimum balance with Interactive Broker? You don't have to maintain minimum balance with Interactive Brokers, but yes, definitely if you're trading in derivatives, you need to maintain some margins. But to open an account, I don't think you really need any substantial amount. Yeah, definitely to just start the account. Again, you really don't basically need to invest any minimum balance and all, right? As in, even let's say if you want to open an account in India, you'll have to just to kind of start the account. The salesperson will come to your home, will at least ask you to give a small check, nominal check. But yeah, no, nothing major to be invested to set up. Okay, yeah. Okay, cool. So I think it's definitely these sessions are, I myself realized that they're quite very short, as in just 1 hour. You definitely need way more time. It's definitely a very deep concept. But again, the purpose was that these are not just theoretical concepts. These are some things that you can apply practically. Okay. So I hope it was useful, and maybe you might be able to apply all these things with your personal wealth also, but definitely not a lot of your personal wealth. Small amount is fine. Okay. Perfect. Thank you very much. Thank you very much, everyone, and all the best. Yeah. Thank you. Yeah. Thank you, Mahesh. Thank you, Sandeep. And good to see you all, by the way, as in so many of you we've met in the class, and good to meet up in a slightly different setup. Yeah. Thank you very much. Thank you. Okay.